How can issuer default impact your commodity, ETN investments? Imagine investing in a financial product that promises to track the performance of a commodity index, but suddenly, the company that issued it cannot meet its financial obligations. What happens next? That's what we're here to explore. When you buy a commodity exchange-traded note, or ETN, you are essentially lending money to a bank or financial institution. Unlike a commodity exchange-traded fund, which owns the actual commodities or futures contracts, ETNs are unsecured debt instruments. This means they are not backed by any physical assets. They are just promises from the issuer to pay you based on how a commodity index performs. If the issuer defaults, meaning it cannot pay its debts, your investment could be at serious risk. You might lose some or all of your money, no matter how well the commodity itself is doing. This is because ETNs depend entirely on the creditworthiness of the issuer. They are like IOUs that relying on the issuer's ability to pay. Since they are unsecured, if the issuer declares bankruptcy, investors are considered creditors. They may end up with little or no repayment. Also, because ETNs do not hold the actual commodities or futures contracts, there's no physical asset to liquidate to cover your investment if the issuer defaults. The market price of a commodity ETN can also be affected by the issuer's financial health. If investors start worrying about the issuer's ability to pay, the ETN's price can fall even if the commodity index is doing well. This means your investment's value can decline due to credit concerns alone. In the worst case, if the issuer defaults, you could lose your entire investment. This total loss risk is unique to ETNs and does not happen with commodity exchange-traded funds or direct commodity investments, which hold physical assets or futures contracts. Liquidity can also become an issue. If the issuer's credit rating drops, trading volume might decrease, making it harder to sell your ETN. Redemption options may also be limited or requiring large minimum amounts, and during financial distress, the issuer might restrict redemptions altogether. So, what can you do to protect yourself? First, check the financial strength and credit ratings of the issuer before investing. Look into the terms of the ETN, including maturity dates, call provisions, fees, and redemption rules. Diversify your investments across different types of commodity instruments to reduce issuer-specific risks. Keep an eye on both the commodity market and the financial health of the issuer. Remember, the key takeaway is that issuer default can cause your commodity ETN investment to lose value or even become worthless, regardless of how the commodity itself is performing. Always weigh this risk carefully when considering ETNs as part of your investment plan.